What is a mutual fund? A mutual fund is basically a single investment that is made up of many different investments. Think of it as like a basket that holds a bunch of different securities or positions inside that basket. What a mutual fund does is it pulls together money from individual investors. It takes that money that it gathers and pools and purchases a lot of different stocks or bond positions. Now, the average positions or securities held within a mutual fund is around 100. So you get a lot of diversification within a fund. Now, if you're an individual investor and you own shares of stock in just one company, let's just say GameStop, because it's in the news right now and you're probably hearing a lot about it. If first quarter earnings or any quarter earnings come out and they are not good for GameStop, most likely what would happen is that the price of the stock would decline. Now, if all your money is tied to that one company, you could stand to lose a lot of money. Now, if you owned a fund and GameStop was inside of that fund as part of the overall portfolio, you stand to lose a lot less because it is a much smaller percentage of that company that you own. So that's one huge benefit that a mutual fund offers, is that diversification. Basically, all your eggs are not in one basket and you're taking less risk, and hopefully you're getting more reward for that. So diversification, huge benefit of mutual fund. Another one is that you have a portfolio manager. So they are the ones that are studying and researching and making the decision about what positions to hold within this mutual fund. They're making the decisions about when to buy and when to sell. Imagine if you were trying to get the same diversification as a mutual fund on your own, and you were studying or trying to figure out which 100 companies to purchase. That would be like a full-time second job for you. Not to mention, you would have to come up with a lot of money to be able to purchase 100 different securities, as well as the transaction costs involved. So that's another huge benefit, is that you have professional management with a mutual fund. Now, there are fees associated with mutual fund. There's what's called an expense ratio, and those range from anywhere from 1% to 3%. 3% is definitely on the high side. We like to look at funds that are 1% or lower with their expense ratios, but that portfolio manager does have to get paid. There are administrative costs involved in running a mutual fund, so every fund does have an expense ratio. Obviously, some are lower than others. There's also things like a sales charge to get in. Sometimes there's redemption fees. So costs associated with mutual funds that you should be aware of. And then there's also just tons of different categories of mutual funds. Each manager has a different focus, a different type of return that they're seeking. I mean, there are balance funds, there's equity funds, fixed income funds, specialty funds, index funds. I could go on and on and on. And then the focus can get even smaller. Within an equity fund, which means the manager is purchasing different stock positions, it can be focused on just what we call large cap, which is just large size companies. And then you can focus in a little bit more, and it could be large cap growth companies or large cap value companies, or it could be focused or targeted on mid-sized companies, small companies, international companies. It can focus on bonds and different type of bonds, high yield bonds, or sometimes you might hear them called junk bonds, or intermediate term bonds, or short term bonds. And so I could go on and on, but basically know that there's a lot of different focuses for the mutual funds out there, and then that there are thousands upon thousands of different mutual funds that are available. Lastly, just one quick note about mutual funds: it doesn't really trade like a stock trades. So you don't sell it like you do on a stock exchange. You redeem it from the mutual fund company, and it doesn't price until the end of the day. So basically, at the end of the day, the mutual fund company calculates its NAV, or its net asset value. And basically what that is it just adds up the number of different positions or shares that it owns in different companies, and divides that by the number of shares outstanding in the mutual fund. and that is how you come up with the net net asset value. So we could go on and on about mutual funds. There's a lot to talk about. If you have any additional questions or want to go a little bit deeper about mutual funds, we would love to talk to you. You can contact us at 586-799-6099. Thanks so much.